Thank you for joining us at xm.com. You're watching today's Daily Market Comment by Mario Sajagiriakos. I'm Christina Marujos. An armed mutiny in Russia over the weekend concluded without any bloodshed. The Wagner Group, a private mercenary army, started to march against Moscow on Saturday following accusations from the group's leader that the Kremlin had attacked his troops fighting in Ukraine via missile strikes. Although most of the details are not clear yet, the insurrection ended quickly after the Wagner Group and the Russian government struck a deal. In other words, Russia narrowly avoided a coup. Geopolitical risks have clearly escalated, and yet financial markets did not care much, even though the Russian ruble fell to its lowest level since the Ukraine war started. Oil prices traded lower in the aftermath, and safe haven assets such as gold barely advanced, unable to attract any serious defensive flows. Over in Japan, the yen has been blown to smithereens by the Bank of Japan's refusal to tighten monetary policy. The collapse in the currency has been so severe that Tokyo has started to threaten FX intervention once again. The latest summary of opinions from Bank of Japan members contains some interesting revelations, such as growing disbelief that inflation will moderate back to its 2% target, coupled with some hints that the central bank might adjust its yield ceiling strategy soon. This narrative shift helped to breathe some life back into the battered yen and setting the stage for a tightening move by the Bank of Japan next month. Speculation about such a move could help the yen to stabilize and perhaps even recover somewhat. Meanwhile, the euro sustained some damage last week after the latest round of business surveys revealed that economic momentum in the eurozone has vanished. The PMIs highlighted that the economy was essentially stagnant in June, even though inflationary pressures seem to be moderating too. Markets are already pricing in nearly 2 additional rate hikes by the European Central Bank this summer, but with economic growth rolling over and inflationary forces fading, the risk is that the central bank will underdeliver. Finally, stock markets drifted lower on Friday in every region. It might be that the weak European business surveys raised some recession alarms, or simply that risk assets corrected lower after a monster bull run this year. All told, U.S. equity valuations have become excessive once again, and with earnings growth being stagnant, it's difficult to see what will propel this market even higher. Thank you for watching the Daily Market Comment here at xm.com. Have a great week.